Ah, yes, the stock market. A place of crushed dreams, confused traders, and mountains of money. So, how does it work? Let's start with stocks. Not that stock, the thing you actually buy, which is a teeny weeny piece of a company. If you buy a stock of Stickman Incorporated, you physically own a tiny piece of Stickman Incorporated. Now imagine the company launches a new product, the Sticker Sorter 3000, an automatic stock sorter. Absolutely revolutionary. The value of the company increases and the price of your stock goes up. You also know a guy called Bob, who really likes his sticker sorter and really wants a stock of Stickman Incorporated. So you sell him yours at a higher price. Stonks. But the price of stocks constantly changes and companies don't constantly make new products. So, dark magic? Nah, just supply and demand. If you are the only person with a stock and a lot of Bobs want to buy it, they pay more. But if there's loads of people with a stock and just one Bob, he pays less. It's actually a bit more complicated because, of course it is, this is the stock market. There's two ways to buy a stock. Limit orders are offers to buy a stock at a certain price, whilst market orders basically say, give me that, and buy a stock immediately at the best possible price. Okay, we've made a big problem. Using these figures, we can estimate a total of 780 million limit orders a day, or 9,000 a second. How do you keep track of that? The order book, a list of every limit order, and it looks like this. That arrow is just decoration, but bids are offers to buy this much stock at these prices, and asks are offers to sell this much stock at these prices. Sometimes you get a fancy graph, but who cares? Look down here, or right here, and you'll see the price of the stock. It's not an average. It's the price of the latest trade. Okay, when Stickman Incorporated releases their sticker sorter, investors love it. They place market buy orders for 50 units of stock. Since there's only 27 at this price, the other 23 are bought at this price. That drives the price up, because remember, this is the price of the latest trade, which happened here. There's also this big scary word called liquidity, which just measures how much price moves. A lower price change means a higher liquidity, which is a good thing. See? Simple. By the way, you have a problem, because the sticker sorter just started throwing stocks at passing grandmas. Investors are panicking and place market sell orders for 100 units of stock. This wipes out these price levels, finishing here, and oh look. The stock just tanked and you lost your money. Tough luck. But wait, what if you knew the price would go down before everyone else? You could sell at a higher price and make money. Or even better, you could buy a future. A promise to buy or sell a stock at its current price later on. The biggest futures market in the US is in Chicago, but the actual trading happens in data centers in New Jersey because why not? The New Jersey data centers are connected to Chicago by a high-speed fiber-optic cable. The cable isn't straight because someone put a mountain range in the way, but still, it has just 16 milliseconds of delay. Not instant, but pretty close. Not close enough for spread networks though. He spent $300 million building a near-straight 827-mile cable that runs through mountains and under rivers with just under 13 milliseconds of delay. It lets traders see price changes before anyone else, letting them buy or sell early, meaning a lot of money. So yeah, that's the stock market. If you want to win, build a big cable. Preferably one that doesn't fling stocks at grandmas, and maybe invest in Stickman Incorporated.